Paying mortgage default insurance premiums when the premium is added to the total mortgage loan amount. All right, so example. Neville offered $579,000 for a home. He was pre-approved for 7% of the effective annual rate for 25-year amortization. He has $90,000 for a down payment, which is 15% of the purchase price. Therefore, the LTV value, the loan to value ratio, is 85%. And you just calculate that by 579, which is the original price of the home, minus his down payment, which is 90,000, equals 489,000, divided by the original purchase price of the home, 579,000, equals about 80 is 84%. So his LTV ratio is about 80. I guess if you round it up, 85%. So, but since the LTV ratio is higher than 80%, it's 84 to 85, this means his mortgage will be high ratio, and he will need mortgage default insurance because any LTV ratio over 80% requires mortgage default insurance. Anything less than a 20% down payment. So, based on premiums from the lender, his premium will be calculated as 2.8% of the mortgage amount, or $13,692. So you calculate that by, that's his loan amount, his mortgage that he needs is $489,000 minus, times 2.8%. And it's $13,692 is the amount of his mortgage default insurance premium. So Neville chooses to amortize the mortgage default insurance premiums over the lifetime of his mortgage. How much will this cost him over the lifetime of his mortgage? All right, so how much will $13,692 premium cost him if he chooses to amortize it over the lifetime of his mortgage? Well, let's look here. Let's clear our calculator. Second function alpha 0 on a bunch of times. So the present value of his premiums are 13,692 PV. Loan, the interest rate is 7% divided by 12 because it's monthly payments. And the amortization period is 25 years times 12 because, again, monthly payments, 25 times 12. And the future value is 0. Let's have it paid off. So what is the monthly payment of this premium amount? So compute PMT, it is $96.77. So by amortizing his mortgage default insurance, it will cost Neville $97 per month, or $29,100, which is $97,000. I'm sorry, not $97,000, which is $97 monthly payment times 300, which is the amount of payments he's going to need, which is one payment per month for the next 25 years. So it's 25 times 12 is 300. So his $97 times 300 payments will equal $29,100 over the life of his mortgage. So what was a $13,692 price tag, I guess, becomes $29,100 if he chooses to amortize it because of the interest over the time span of his mortgage. Now, Neville has a couple other alternatives if he does not like spending more than double on his insurance premiums, and they are, so the alternatives Neville has is, number one, he can make an additional down payment of $25,800 to avoid making mortgage default insurance premiums. So basically it's $90,000 plus that he already has of a down payment, plus this $25,800 equals $115,800, which is 20% of the purchase price of the home. And so the LTV value will be 80%, and he will not need this mortgage default insurance premium at all. So that's one way he could get rid of it or not have to pay more. It's still less than if he paid amortizing it over the mortgage, the entire time of the mortgage. So that's an option. And also he Option number 2 is he could pay the mortgage default insurance premium of $13,690 in cash right away to avoid any interest payments. So those are the options that Neville has. He could either avoid the payments totally, or he could pay it all in one lump sum, which is still significantly cheaper than amortizing it over the life of his mortgage.